Ladies and gentlemen, welcome to BOQ's full year result for 2016. My name is Tani Mangos and I'm the General Manager of Corporate Affairs and Investor Relations. Thank you for joining us today in the room, on the phone and via the webcast. For today's presentation, we will have CEO John Sutton provide an overview of the result, then our CFO Anthony Rose will run through the numbers, and then John Sutton will come back and provide an outlook and the priorities for the period ahead. This will be followed by the opportunity for analysts and investors only to ask questions. I'll now pass on to John. Thanks.
Well, thank you, Tani, and good morning to everyone, and thanks for joining us for BOQ's full year 2016 financial results. Almost a year ago, I stood in front of you and presented BOQ's updated strategy, a strategy that is more about evolution than revolution. Since the strategy update, our focus on specialised customer segments and products is on track to deliver a superior outcome in the long term for the bank. With our refreshed strategy in place, it's time to review our culture. In April this year, we launched our 1-4-4 culture, one vision to be Australia's most loved bank, supported by the 4 strategic pillars: customer in charge, grow the right way, there's always a better way, and love like no other. And 4 values, which are passion, integrity, collaboration and impact. We're seeing good traction with our refreshed culture, and our strategy continues to serve us well, which is reflected in today's results. I'll begin with an overview of the result on slide 4. Our strategy has delivered an increased profit in what is a changing operating environment. Interest rates remain low, market volatility continues, regulatory requirements are increasing, and competition for both loans and deposits is intensifying. One of the most pleasing aspects of this result is the strong contribution from our specialist niche businesses. BOQ Specialist continues to exceed our expectations, and BOQ Finance is delivering strong returns. Another highlight of our 2016 result is the strong asset quality across all portfolios. While supported by low interest rates and relatively low unemployment levels, this improvement is the direct result of the disciplined approach we have taken to risk management since 2012. The business is now better placed to withstand the ups and downs of the Australian economic cycles. Because of the subdued revenue growth across the sector, low credit growth and low interest rate environment, we have sharpened our focus on productivity and deposits. In February, we announced a one-off $15 million investment to refine our operating model. This investment is on track to deliver above its payback target over the 12-month period. We've also kicked off a further number of other efficiency initiatives within our current expense profile to deliver additional cost savings in future periods. Meanwhile, the expansion of our distribution channels and our increased emphasis on deposit gathering has seen a rise in our deposit-to-loan ratio. We see further upside in this over time as our focus on deposit extends to all business groups within BOQ. We continue to progress well with the execution of our strategy, which I'll go into some more detail during the presentation. Turning to the headline numbers on slide 5. For the 4th consecutive year, we have delivered increased cash earnings. In FY16, cash earnings after tax increased to $360 million. This is up $3 million from the prior year. Earnings per share decreased slightly from 97.3 cents in 2015 to 95.6 cents in 2016 due to the share issuance through the dividend reinvestment plan to support risk-weighted asset growth. The bank's Common Equity Tier 1 capital ratio is very strong at 9%. The board has chosen to maintain the half-yearly dividend at 38 cents, which means the full-year dividend has increased 2 cents from 2015. Return on equity decreased 40 basis points to 10.3 in 2016. Looking briefly at the drivers of the result on slide 6, our strong first half lending growth moderated significantly in the second half, resulting in $2.2 billion in total lending growth for FY16 at 0.8 times system growth. Net interest margin reduced 3 basis points over the year. Tougher funding conditions and increased price competition impacted the NIM in the second half. Cost to income increased to 46.8%. This includes $15 million investment in efficiency we announced in February. It also includes the step up in amortisation we flagged in prior periods and the investment in Virgin Money's mortgage product rollout. Loan impairment expense reduced to 9% to $67 million, or 16 basis points of total loans. This is an extremely good result given the transition that is continuing to occur across the economy. BOQ Specialist is making a significant contribution to the overall quality of BOQ's mortgage book. Anthony will talk through the numbers in more detail shortly. As I mentioned in my opening remarks, we're seeing some pleasing results in our niche businesses. Let's take a look at some of the achievements in detail on slide 7. BOQ Specialist has continued its momentum, delivering sustainable returns. Commercial loans grew 13%. This was achieved while maintaining good margins and low loss rates. The mortgage portfolio has also continued to go from strength to strength. The $1.5 billion of growth in 2016 helped to build a high-quality residential loan portfolio. BOQ Finance, our quiet achiever, has also delivered good returns. Asset growth increased 3% in a flat market, with loss rates moving in line with expectations. Growth in the niche business banking segment was above system. Over the year, we've realigned bankers and credit specialists with the target segments, and we're seeing positive early results in retirement living, hospitality and agribusiness. I'm also pleased to report that Virgin Money has launched its Reward Me home loan product through 800 accredited mortgage brokers. Since its launch, we've received $100 million worth of home loan applications. We're also planning to launch of a Virgin deposit product in the next 12 months, enhancing the current customer offering. Turning to slide 8. I just want to reinforce the continuous improvement in asset quality that we've delivered over the past 3 years. A number of our credit metrics demonstrate that the portfolio is in great shape and much better placed to cope with the ups and downs of the Australian economy. Our Queensland concentration is down to 48% in 2016 from 56% in 2013, with the broker channel and BOQ Specialists contributing to this diversification. We expect Virgin Money mortgages and growth through our niche businesses to further improve our geographic diversification in the periods ahead. Since 2012, we've had sound risk management settings in place, and this has significantly reduced our exposure to residential apartment development hotspots and mining-reliant regions. The long-term commercial arrears chart on the bottom left of this slide shows the significant improvement in that book over time, as does the impaired asset chart on the bottom right. We remain vigilant, especially when it comes to our exposure to regional economies that have differing economic conditions. Anthony will provide more detail on the quality of our loan book in his section. As I outlined earlier, there are a number of industry-wide headwinds which have emerged in 2016. Expectations of lower interest rates in Australia for longer has meant a lower rate of return on capital and low-cost deposits. A widening of spreads in term deposits and other liabilities has emerged alongside fierce competition for deposits. Meanwhile, there's been continued competition in pricing for new lending as system credit growth slows and banks seek to keep their balance sheets growing. This resulted in our net interest margin contracting 3 basis points over the year. We have taken steps to adapt to this low interest rate world. Given the expensive funding environment, increased competition and BOQ reaching its investor cap, we slowed asset growth in the second half following a strong period of growth in the first half. During this period, we focused on growing higher margin asset segments, in particular commercial lending. The retail business increased its deposit gathering in the second half, more than doubling the growth it achieved in the first half. The emphasis on deposits has also been extended to all business groups within BOQ. Turning to slide 10. As well as balancing margin and growth, we've always maintained a strong focus on costs. In 2016, we kept underlying expense growth to 4%. The $15 million investment we announced in February to refine our operating model is on track to deliver its 12-month payback target. We currently have a number of additional efficiency initiatives underway which fit within our current expense profile and will deliver important expense savings in the years ahead. Some of the initiatives include the merging of duplicated or similar processes across the banks into centralised hubs. These will deliver a leaner and more efficient operating structure. We expect to keep underlying expense growth to 1% in 2017 while continuing to build out our multi-channel niche segment market strategy. We've made good progress across our strategic priorities in 2016, with the majority of these focus areas remaining relevant in 2017. An important achievement in 2016 included the launch of the Virgin Money Reward Me home loan, which is a unique offering. While it is early days, we believe this business will deliver a meaningful contribution to the group over time. We now have more than 4,000 mortgage brokers accredited across BOQ. This will expand further in 2017. During the year, we rolled out a new commercial lending platform and made good progress on the next stage of our retail lending system. Both platforms will automate previous manual paper-based processes and deliver a quicker time to yes for our customers. Our digital journey is in its early stages, but I'm confident there is plenty of upside for us. Our size allows us to partner, which will significantly improve our digital capability and offer improved products and services. For us, this means opening our application programming interface, our API gateway, which will allow more open architecture plug and play. We have started exploring the use of data analytics. This will provide meaningful insights into customer behaviours and preferences when it comes to mortgages and deposits. The branch network continues to transition, with a reduction of 23 branches over the year as customer preferences continue to shift towards digital channels. There is still an important place for our branches in our distribution strategy, and the OMB model remains a key component of this. We have a total of 13 Icon branches. Across the Icon branches, we continue to see an uplift in settlements, deposit growth and cross-sale metrics. I am pleased with the progress we have made. I am confident of meeting our goal to deliver industry EPS outperformance over the longer term. I'll now hand over to Anthony to talk through the numbers in more detail. Thank you.
Thanks, John. Starting with the P&L on slide 13, you can see that total income was up 2% over the year, with NII up 3% and other income down 4%. Expenses increased 4%, which was in line with expectations and driven largely by the higher amortisation profile we've called out previously. This meant underlying profit was up 1% to $590 million. As John mentioned, loan impairment expense was down 9% to $67 million. This was a pleasing result, with the second half impairment charges equivalent to 14 basis points of gross loans and advances. The net result being a cash earnings of $360 million, up 1% on 2015. I'll now take you through each of the line items in more detail. Starting with lending growth, and I'm referring to slide 14, we achieved growth of 5% over the year, which was 0.8 times system. This growth was heavily front-ended, as you can see on the chart on the bottom right-hand side of this slide. Our geographic distribution is shown on the chart on the bottom left. Queensland concentration is now down to 48%, 56% 3 years ago. As we mentioned at the half-year results, we did see an opportunity to generate momentum in our retail channels at the end of calendar 2015. At the half-year, we flagged that second half growth would be lower than the first half. However, it's fair to say that the environment was more difficult than we'd envisaged, with competition intensifying in mortgages and retail deposits in particular. With the backdrop of falling interest rates, we took a conscious decision to stay out of the most competitive end of the market, and growth slowed significantly. We prioritised margin over growth and increase the emphasis on deposit gathering. There has been some retracement in the level of front book discounting in the market since the August RBA rate cut. We see current new business momentum improving, the growth rate above that achieved in the last half. But given the difficult operating environment, we are more than comfortable if our growth is below system for the time being. Looking more closely at the housing portfolio on slide 15, which splits out channel performance, you can see that BOQ Specialist has continued to make a good contribution to housing growth, growing $1.5 billion over the year. If you look at the chart on the top right-hand side, this shows settlement volumes by channel. It demonstrates that even with the pricing changes we made during the year, our OMB and corporate branch channels continued to provide a relatively consistent level of housing settlements, despite a reduction in overall branch numbers. The broker channel, on the other hand, has seen the biggest reduction in flows in the second half, as our new business pricing moved away from the front of the market. At the end of August, we launched a new economy product which has an attractive rate but less features than our ClearPath product. This should enable us to stay on the consideration step with customers while giving us the ability to achieve a better margin on ClearPath loans for those customers who want a more fully featured product. Meanwhile, the Virgin Home Loan product will provide a new channel and new customer base for growth, and we expect BOQ Specialist to continue expanding its penetration into the medical and dental sectors. Turning to the commercial book, loan book on slide 16. In the second half, we did see the growth rate improve by 30% from that achieved in the first half. This would place growth at a little above system over the period. The business banking, BOQ Specialist and BOQ Finance portfolios have all shown good momentum. This demonstrates the success of our niche segment strategy, which John has already talked to. The geographic concentration of our commercial portfolio to Queensland is now down to 41%. In the second half, we have seen an improvement in the market dynamic in the mid to larger end of our commercial portfolio. It appears that the increase in bank term funding costs that had emerged some time back is now priced into rates being offered to customers. We hope this continues. As we've said before, we'll continue to grow selectively when it makes sense to do so. The margins on our BOQ Specialist and BOQ Finance businesses also remain at attractive levels. We'll continue to pursue a risk versus reward growth strategy aligned to segments where specialisation of industry knowledge can deliver superior returns. Moving to the liability side of the balance sheet on slide 17, and I'm pleased to report that we fully funded the $2.2 billion in asset growth through deposits in 2016. This lifted our deposit to loan ratio by 2% to 68%. We continue to see good momentum in transaction account growth of $320 million over the period, or 12% year on year, and these figures do not include offset account balances. Transaction account growth is extremely important for building relationships with customers, as well as for the resilience of the balance sheet. We remain comfortable with our funding profile, but given the industry dynamics, have increased the emphasis on deposit gathering in all of our distribution channels. I'll cover the competitive nature of the retail deposit market on the next slide, slide 18. On this slide, we provided a few charts which help illustrate some of the changing dynamics facing banks in the current environment. Starting with the two charts at the top, it's been well documented that interest rates are at historical lows, with the 5-year swap rate, charted on the left, now down below 2%. The chart on the right shows what this means for our replicating portfolio, which covers the investment of our capital and low-cost deposit portfolio and has an investment profile of 5 years. Essentially, 1/60th of the portfolio reprices every month. As you can see, over the year, the reinvestment rate has, on average, been 3.25% lower than the historical investment rate. I'll cover the impact of this has had on our margin shortly. The chart on the bottom left shows what has happened to term deposit spreads across the industry since May, when the RBA cut rates and the yield curve shifted down with expectations of further cuts. With term deposit rates hardly moving, and in some cases moving up rather than down, we saw average spreads blow out in the last quarter. For any bank that sources a high proportion of its funding through term deposits, this is going to have an impact on margin. Finally, the chart on the bottom right is one that many of you have seen before. It shows the spread between the 90-day bank bill rate and the overnight index swap. The chart shows that the cost of hedging increased from a long-term average in the low 20s to over 30 basis points from December through to August. Thankfully, we've seen this spread stabilise, but the impact that this has had on our hedging cost over the 2016 financial year has been significant. Whilst there does seem to be some easing in this dynamic towards the end of the year, we have seen a worsening of the 6 to 3 month hedging costs that is used to manage our retail and wholesale term deposits. So we do not expect any benefit in the short term. Turning to how these and some of the other moving parts have impacted our net interest margin, and I'm now on slide 19. We've provided a high-level half-on-half walk. I'll take you through each of the buckets in more detail. Asset pricing and mix provided a 4 basis point benefit over the half. This included the repricing actions taken during the year on the mortgage portfolio that positively impacted NIM by 9 basis points. The front-to-back book pricing dynamic that has prevailed in the market, combined with retention repricing activity, has had a 3 basis point contractionary impact on NIM, similar to the impact in the prior half. A reduction in equipment finance renewal income over the half reduced NIM by a further basis point. However, this resulted in higher equipment sales income generated on this portfolio that's reported in other income. A further basis point of NIM degradation was caused by a combination of product mix and the impact of a higher proportion of lower yielding government bonds in the bank's liquids portfolio to satisfy APRA's APS 210 liquidity standard requirements. Within funding costs and mix, as highlighted on the previous slide, we saw competition funding intensify over the half at the same time as the yield curve contracted. This caused a 4 basis point negative impact to NIM. Half of this impact was evident in retail liabilities, as increased competition meant absolute term deposit rates did not fall in line with the movements in the curve. The majority of this impact occurred in the last quarter. A further 2 basis points of impact occurred in wholesale funding costs. As global market volatility increased, funding costs widened in the domestic short-term wholesale and middle markets. This was coupled with the industry's push to increase duration across all funding segments, including shifting short-term wholesale funding beyond 6 months duration in preparation for the impending introduction of the net stable funding ratio regulatory requirements in January 2018. Hedging costs are also included in this bucket and increased by 3 basis points over the half, as we forecast at the first half results release. Looking at capital and low-cost deposits, the lower yield curve impacted returns on the bank's replicating portfolio, as identified on the previous slide, causing a 4 basis point reduction in the half. That was a basis point higher than we'd previously flagged due to the further contraction in the yield curve as the RBA reduced the cash rate. The outlook for NIM remains difficult to forecast given the number of moving parts and the dynamic nature of markets we're operating in. As I showed in the previous slide, hedging costs have stabilised since August, so this headwind should not be present in 2017, assuming the current market position is maintained. The front book versus back book pricing differential will continue to come through given the current market structure and the nature of competition. Although pleasingly, we've started to see some evidence of rate reductions in new business discounts since the August rate cut. We expect a similar magnitude of impact from the return on capital and low-cost deposits in 2017. This leaves the dynamic in funding markets as a key variable which is difficult to predict. Based on current market conditions, we'd expect this to remain a headwind for us into 2017. So to sum up, the margin outlook will really depend on to what extent the industry looks to shelter the ongoing headwinds that are currently impacting margins. We'll have to see what the competitive environment brings for new business acquisition and back book pricing in both loans and deposits. This is against a backdrop of regulatory capital changes, whilst the industry ensures that it maintains unquestionably strong status. We would advocate solid returns are an important element of the industry's unquestionably strong status and is essential given Australia's reliance on offshore funding sources to fund its banking system. Moving to non-interest income on slide 20. This line item usually has some noise attached to it, and this year is no exception. We provided commentary at the first half around movements impacting that half, including $3 million interchange fee impact that hit banking income, a $2 million benefit from improved equipment finance sales in BOQ Finance in the other income bucket. The increase in BOQ equipment finance realisations lifted a further $2 million over the second half and contributed an increase of $6 million over the year in aggregate. In the banking income line, over the year, we've also seen a $3 million reduction in third-party brokerage received due to BOQ Specialists' shift towards on-balance sheet mortgage originations. Now covering St Andrews. We've previously flagged a $3 million expected reduction in the underwriting result, resulting from the shift in product mix occurring in the business, as well as the impact of renegotiated distribution agreements with major partners. In 2016, we've seen this impact slightly higher at $4 million, with an accelerated shift in product mix through the period. Looking at the half-on-half comparison, we saw a lower level of claims in the first half, but this reversed in the second half. Overall, though, the claims expense was in line with full-year expectations. The other element that has impacted the St Andrews result is the investment income component, which has reduced, as you'd expect, in a lower income environment. This was a $2 million impact over the full year. Going into 2017, we expect the shift in business mix has largely now occurred, and the contribution from the growing wholesale partnerships is expected to largely offset the residual impact of the refreshed corporate alliances. Looking at non-interest income in total, as we've been saying for some time, the business is working hard to deliver a flat profile. Turning to expenses on slide 21, there are a number of items to consider. The $15 million investment we flagged in February to refine our operating model is one-off in nature, but we've included it in our cash earnings numbers. Given we had $16 million in one-offs in 2015, also above the line, it doesn't really matter whether you include or exclude these one-offs. Our expense growth was 4% for the year. This is in line with the guidance that we gave last year and is predominantly driven by higher amortisation resulting from increased capitalised software as we've sought to reinvest in the business over the last 3 years. If we were to exclude the increase in amortisation, our underlying expense growth would be 2%. This includes the $3 million increase in costs associated with supporting the rollout of the Virgin Money home loan product. We expect the full year cost of supporting the rollout of this channel to be $12 million in 2017. The $15 million investment to reshape the operating model and organisational structure is on track to deliver the planned 100% payback through cost savings within 12 months. Other initiatives underway include the creation of a centralised lending hub model, which will deliver a customer-centric and cost-effective end-to-end process for lending services across a majority of the broader BOQ group. We're also looking at better leveraging shared services centres of excellence across the group. We are confident that further savings will be generated from this initial investment, which will enable us to implement these and other efficiency initiatives within our current expense profile. So even with an increase in the cost of the Virgin Money mortgage offering I've covered, and a further uplift in IT amortisation expense in FY17 of $10 million, we are targeting underlying expense growth of 1% from the $505 million underlying result we delivered in 2016. If we now move on to slide 22, and I'll cover asset quality. The bank's strong credit metrics are clearly evident across the portfolio. Both loan impairment expense and impaired asset balances have trended favourably. Looking across the portfolios, retail has continued its improvement, with BOQ Specialist mortgages providing an important contribution to this increase in quality. The retail portfolio has also been aided by record low interest rates, strong property market conditions and faster clearance rates. In the commercial book, we've seen a good reduction in impairment expense over the second half, with no new impaired assets greater than $5 million being recognised. Meanwhile, BOQ Finance has continued to track around the levels we'd expect in terms of impairment expense as a proportion of gross loans. The majority of this book continues to perform extremely well, with the tail in Queensland and WA regional exposures driving the impairments we're seeing, as the economy continues its transition away from its previous reliance on mining investment. Overall, we are reaping the benefits of a disciplined approach to risk management since 2012 and are seeing the echoes of the past continue to diminish. Similarly, our arrears trends on slide 23 also demonstrate sound performance across all portfolios. Retail arrears performance remains sound. We have seen some increases in delinquencies in mining and regional towns, but we remain comfortable with the portfolio position. Commercial arrears have improved substantially over the full year in both 30 days and 90 days past due, each down approximately 30%. The benefits of the new risk appetite and credit practices established in 2012 are evident. During the period, the business had excellent success in early identification, intervention and rectification of troubled accounts. This evidences the risk management capability of the group that is a key strength. Moving to capital, and I'm now on slide 24. We remain very comfortable with a 9% Common Equity Tier 1 ratio as a standardised bank. If you were to equalise the average risk weights in the denominator between us and our advanced accredited peers, we would show a far superior position. In terms of the movement over the half, we had very strong capital generation, benefiting from the lower level of risk-weighted asset growth. Over the next 6 to 12 months, we look forward to gaining clarity on the next evolution of the Basel Committee's approach to risk weightings and capital, and the way this is interpreted by APRA here in Australia. There are a number of areas we are watching closely. Based upon the most recent consultation paper, there appears to be some potential benefit for us in our SME commercial portfolio and our leasing portfolio, with lower risk weightings in the order of 75% appearing to be proposed compared to the 100% risk weighting we apply today. We would hope changes in this space open up more areas of the market where we can compete for a broader set of customers that deliver us appropriate returns. Levelling the playing field has been a key driver of these global changes, and a lot has been spoken about as it relates to mortgages here in Australia. We do believe the interim changes that APRA has already introduced, with the advanced bank floor of 25%, do not level the playing field sufficiently, and that more is required to achieve that objective. The big swing factor that the industry is watching in relation to mortgage risk weights is the setting of risk weightings for investor loans that are materially dependent on cash flows from the collateral property to make repayments. The definition of materially dependent is still to be agreed, as far as we're aware, but expect the industry will adapt to the new regime regardless of what the outcome is. We remain optimistic there will be further convergence between standardised and advanced approaches to risk weightings, which would improve BOQ's relative competitiveness with advanced banks. If I could ask you to move on to slide 25. Depending upon where things land, and we hope to have clarity on this sometime in 2017, we should be in a better position to assess what benefits could be obtained from moving to advanced accreditation. As we've said a number of times before, although we haven't had a formal program in place, we have been implementing a number of initiatives that would be required as part of our journey to achieving advanced accreditation. We've made good progress on a number of these initiatives, but there still are a number of outstanding steps we'd need to take before being in a position to put an application to the regulator. Once we are able to assess the size of the prize, we will be able to determine whether acceleration of these steps and the associated investment required is warranted. With that, I'll hand back to John.
Well, thanks very much, Anthony. Before talking about the outlook for BOQ, it's important to set the scene with the macro environment we're operating in. Firstly, the broader economic environment. Overall, the Australian economy is performing reasonably well. Low interest rates, relatively low unemployment is supporting GDP growth. Economic performance has remained mixed across the states. WA is still struggling with the end of the mining boom, while low interest rates, strong population growth are helping the New South Wales and Victorian economies. The Queensland economic performance has been mixed, with strength in the southeast offset by weaker activities in areas influenced by mining such as Townsville, Gladstone and Mackay. Tourism has been a plus. 3 of the 4 fastest growing airports in Australia have been in tourist areas of Gold Coast, Cairns and the Sunshine Coast. Net interstate migration to Queensland is at its highest level since December 2012. And export services of tourism and education from Queensland have risen to more than 12% in dollar terms. In its most recent budget, the Queensland State Treasury projected export growth would help the state economy increase by a strong 4% in 2017 financial year. LNG production will be a key contributor. As I've already indicated, the outlook for the banking sector remains subdued. Low interest rates, low growth environment, increasing regulatory requirements, volatile funding markets and increased competition for loans and deposits all impact the sector's ability to maintain revenue growth as it has in the past. With record low interest rates, deposit holders want better returns on their cash. This creates an interesting dynamic for banks looking to increase deposit balances and reduce dependency on wholesale funding. Conduct and culture is a huge focus across the industry at the moment. At BOQ, we understand that banks have a social licence to operate, and we take this very seriously. We are committed to operating with the highest ethical standards. Our executive team and many of our staff have voluntarily adopted the banking and finance oath. We also established our very own ethics committee in 2015 and commenced the rollout of ethics training. Add to this our support of the ABA 6-point plan and ASIC's extension of powers, we remain focused on running a bank based on trust and ethics. Bank customers are increasingly adopting digital and mobile channels. The number of fintech startups are growing by the day as technology creates opportunities for disruption across different parts of the value chain. We see this as an opportunity to partner with fintechs and to accelerate our digital enablement. On the regulatory front, as Anthony has said, we look forward to seeing some certainty around the revised, standardised and advanced approaches to capital management. We await eagerly the outcomes of Basel IV at the end of the year. This will provide clarity on the benefits that will be obtained in moving from standardised to advanced accreditation. Meanwhile, the net stable funding ratio requirements are contributing to increased competition in the deposit market. Turning now to our priorities in 2017 on slide 28. We have successfully transformed from a monoline distribution business to one with multiple distribution channels. The Virgin Money brand currently has 800 accredited mortgage brokers from Plan and Fast. This is about to be expanded with signing of 2 large aggregator groups. Combining this with BOQ's existing broker channels, this will increase BOQ's overall access to 75% of the broker market. Further expansion of our broker channels, combined with our ongoing network productivity, will strengthen the quality of our book by attracting a more diverse customer base. We will continue to grow the right way by optimising our deposit growth with the help of data analytics. We'll also continue to invest in building capability across our niche target business segments and in high-margin businesses. Our strong focus on managing costs will be delivered through a number of initiatives which form part of our efficiency program. Aligning our people with our vision to be Australia's most loved bank is important to our success. We will continue to invest in our leadership, diversity and ensuring all of our staff understand the importance of maintaining the highest ethical standards possible. All of these priorities position us to deliver our goal of EPS outperformance over the longer term. In summary, we've delivered today a set of results that highlight the progress we're making against our strategic objectives. Our increased profit for the 4th consecutive year has been achieved in a changing operating environment. The strong contribution from our specialist niche commercial businesses is pleasing. Our disciplined approach to risk management has improved the asset quality across all portfolios. And the one-off $15 million investment to refine our operating model has delivered ahead of its targeted 12-month payback period. Looking ahead, the outlook for revenue growth across the industry remains subdued, but we are well positioned to operate and adapt to this new environment. We will continue to focus on growing higher margin segments while maintaining our risk discipline. Managing our costs remains key to our success. This will be supported by the rollout of further efficiency initiatives. We are committed to our strategy, which provides significant opportunities for growth, which the bank has not had in the past. I'll now hand over to Tani to moderate the Q&A. Thank you.
Thank you, John. We'll be taking questions from analysts and investors only. For those in the room, please state your name and the organisation you represent and just wait for a microphone. Let's start with the room first.
Thank you. John Mott from UBS. I've got a question. It's on the average balance sheet. So if we can get you flick to page 32 of the 4E, I think you might have that if you go in front. While you're flicking there, one number that stood out to me was the yield on the retail deposits in the half. And if you go through from the first half, the yield was 2.33. It actually rose in the second half to 2.35. So if you compare it to the cash rate, I know you've difficult year in with the RBA right then, but the average cash rate fell 20 basis points, but the yield on the deposit book actually rose. Now, Anthony, you talked about that a lot. There's a lot of competition, especially in term deposits. But are we now at a stage where you can't really get the yield on your deposits down much more while continuing to grow your book and meet the net stable funding ratio, in which case you're going to have a lot of problems with your margins if competition on the asset side continues to increase or continues, or also if the RBA cuts rates again. There's effectively, are we now at a floor on deposits, which puts you in a pretty difficult position for your margin?
I think you've exceeded what you did last year, John. I think you've asked a 9-part question, and last year was 8. So I might just deal with the outlook on deposits and what we're actually seeing. In fact, in the last week and a half, we've actually seen a moderation in those term deposit rates across some parts of the curve, particularly that 12-month part of the curve and also in the 24-month part of the curve. So we've actually seen the industry start to bring those deposit rates down. It's an interesting question that you pose about where the industry will go, along with if there's further RBA rate cuts, and we're not immune to that, and we'll see where the industry moves with that. And again, it's hypothetical whether the RBA will cut or not cut, but certainly from our perspective, we're doing a lot of work on data analytics. We're doing a lot of work on demand and where we see demand for deposits in various parts of the curve, and we're responding to that. And we believe that over time that we'll be actually able to manage both sides of the balance sheet, and particularly on the deposit side, because we do have a lot of deposits, to make sure that we remain competitive, but also to manage that margin and fight for every single basis point.
I think that answers the question.
Any other questions in the room?
Thanks. It's Ed Henning from CLSA. Just on the non-interest income, you talk about you're going to work hard to deliver a flat profile going forward. You've said the insurance income's kind of normalised, so you don't really have a headwind from that. Obviously that leaves your trading, your banking fees and the other. Can you just run through what are the headwinds that I know you did have some realisation of your BOQ specialist assets in there. Is that the headwind? Obviously, although you're growing, you plan to go potentially below system, you're still growing your book. So just run through what are the headwinds there for us?
Well, there's a continuing shift, I think, away from older style, higher fee based products to lower. So our ClearPath mortgage product is a lower fee product than the older package products that we'd had historically. So there is an element of that trend that continues to come through. And as we've called out industry-wide, I think customer preferences towards low-fee transaction accounts has also been prevalent. The equipment realisations piece has certainly helped shelter our overall non-interest income performance over the period. How long that continues at that level Again, what we've seen and what we have evidenced this period is a bit of a shift between net interest income and non-interest income, and if that was to turn back the other way, we'd probably expect to see a similar reversion in the net interest income line. We've talked about some of the other items that are in there, but in the change in strategy that BOQ Specialist had over with the on-balance sheet strategy as well, that was obviously a headwind during the period, and interchange fees I think has also been called out quite consistently across the sector.
But that's not a headwind going forward though, the interchange fees or the...
No, so you're asking the question around, again, I think that just the general trend of reduction, we think and we talked about trading income probably in this period a little bit higher than, for the half, was probably a little bit higher than what we'd expect. I think consistently repeatable is the words we've been using in the past. And yes, you do get some natural growth in the balance sheet, but I think the guidance we've given is our best guesses of the moving parts as we sit here today.
I think, Ed, you've also got to look at what's generally happening in the industry, and we're very attuned to what customers want as well. And bundled package products are probably sort of on the way out, whereas people are looking for very transparent products with low fees, and that's why we actually introduced the Economiser home loan, which is really important for us. So it doesn't have the same features as what ClearPath does. ClearPath is a very good product, but the Economiser product actually gives a relatively low rate. The acquisition NIM on that is higher than what we've had in the past for other introductory products, but again, it just balances that out. But the industry itself is looking for greater transparency in its banking products.
Thanks. And just while I've got the mic, I might steal in another question. Just on your provisioning coverage, obviously you had a good result during the period, but your collective provisioning coverage kind of fell, whether you look at loans, whether you look at risk-weighted assets. Can you just run through, obviously how you're clearly comfortable with it, but what's going on there?
So the key driver of the movement in collective provision in the half was really the success that the credit and the workout teams had around moving out of the organisation a number of troublesome watchlist accounts, and had some really good success in that space. I mean, that is certainly helped by the property markets and those things that customers can look at deleveraging and asset sales to do so with some degree of success. But that's really been the major driver. So it's been fundamental improvement in quality of the book.
Thanks.
Richard.
Good morning, Richard Wiles, Morgan Stanley. I've got a couple of questions. First one's on credit quality and the second one's on expenses. On slide 22, the loan impairment expense by product shows that there was a huge improvement in commercial in the half, which was a key driver of the group loan loss charge falling. The new impaired asset chart below it shows that you didn't have any single name problems, with no exposures over 5 million in the new impaired bucket. But the exposures below 5 million went from around 60 million in the previous two halves to 80 million. What does that tell us about sort of broad credit quality trends for the SME segment? It would suggest that things have actually got a little bit worse rather than better.
It's you've got to look at it almost by regional geography, and some of the indicators that we actually see come through our equipment financing book. It's just a wonderful portal into what's actually happening in the SME world, because largely that book is wheels and motorbikes and small business equipment to support businesses. The way I would look at it, and with the downturn in mining investment in a lot of Western Australia and also in far north Queensland, some of that, it's like throwing a stone into the pond. That ripple is starting to spread out a little bit to companies that were servicing, say, mining-related towns. So, for example, if you owned a fleet of trucks that were driving up and down the highway from Brisbane up into far north Queensland, we're starting to see some of those smaller businesses, they may have lost some contracts and they would start to go into impaired. For us, reiterate again, we don't have any big single name exposures to mining companies or mining related regions. The book is quite diverse across the regions. For example, on the retail side, When Queensland nickel shut down, we actually had a team up there really, really quickly to make sure that we had hardship available for those people affected by that shutdown. And certainly those mining-related towns are struggling, but they've also got a lot of resilience as well. And it'll take a while for that to transition through. So I think those small firms that are reliant on that lot of investment will do it tougher.
Okay. And my second question's on expenses. You've guided to 1% underlying cost growth for next year, but you've also said that the Virgin costs will be higher, around 9 million. Amortisation will be higher. That looks like it might be a similar increase.
Yep.
So what you're telling us is that outside of the Virgin and amortisation cost increases, you expect your underlying cost to be down 3, 4, 5%, something like that for 2017. Is that correct?
So the normal inflationary impacts, if you like, in the various elements of our expense base that are effectively embedded. We talked quite a bit today about the efficiency program, and I think when we launched that $15 million in February, we did make it very clear that that was meant to be a catalyst to kick the organisation into a mindset of continuous improvement and reinvestment in efficiency and productivity. And I think as we sit here today, we had optimism 6 months ago. We've got a lot more confidence about the actual plans that we've got in place to deliver on those efficiency objectives. I think, as we've also said in the past, we are coming from further back from a capability perspective compared to some of our competitors, and we're really treading a path that other institutions have already trodden before us. So we're not breaking new ground in a lot of sense in achieving some of the things that we're looking at doing, and I think so there will be those benefits that come through that help to shelter the underlying inflationary impacts in the cost base.
Andrew, I think, had a question.
Thanks. It's Andrew Triggs from Deutsche. Just a question on the broker channel. Trying to get a sense, Anthony, or in respect of how long you think a return to growth is likely to take. If we look at both the chart that you provided in the pack, but also the AFG competition index that shows little improvement in the recent months. And also how you sort of propose to manage the Virgin Money and BOQ brands in that same channel.
Yeah,
will you prioritise the Virgin Money brand?
We're brand agnostic, and that'll be driven by consumers. And the one thing I'll say about the Virgin brand is it attracts a materially different customer base to what the BOQ brand does. So that will complement over time. And Virgin has had really strong growth in its credit card portfolio and its insurance sales. We've now got the home loan out, and it will be in the two biggest aggregators very shortly. In terms of the brokers, prior to 2013, we were zero in the brokers, and we're starting to see between 15 and 19% of our home loan volumes come through the brokers. In this start to the new financial year, we've certainly seen increased activity levels over and above where we were in the second half, particularly with our spring campaign. And I would expect that over the coming years that we'll continue to see growth through the broker channel. Now, we have to make sure that we've got the right sort of products, got the right processes to service the brokers. We're doing a lot of work on that. Part of our cost efficiency is to actually get to one back office and to automate a lot of that process as well, which we're doing. But over time, we'll continue to see growth there.
Do you think you've damaged the reputation in the broker channel by sort of growing too quickly and not being capable of dealing with the high demand that you had?
Look, we've got great acceptance from the broker channel, and obviously there are always lessons learned, and we're working very hard with the brokers that we deal with. They've supported us very well over the last few years, and will continue to do so. We need to make sure that our products are competitive. Our turnaround times to yes is industry best, is industry practice. With our new RLO system, retail lending system coming on board, we'll be able to service our brokers, our owner managers, our corporate branches, and give them the time to yes that they all want.
I think the other dynamic on that chart that I showed does demonstrate that we really were unable to match the market as where the market was, really up until there were movements in August. So some back book repricing and some front book retracement. We're a lot more comfortable now that we're in the market and on the consideration set, and as John said, we've focused on the plumbing during this period, and when all of those things come together, we do think we're going to get better momentum, certainly, than we achieved in this half.
Are there any other questions in the room? Just here in the front.
Thank you. It's Andrei Stadnik from Morgan Stanley. I just had a question on deposit pricing. We noticed that during the second half of 16, BOQ was very aggressive on deposit pricing. For example, on 90-day term deposits, the carded rates were maybe around 60 basis points ahead of the majors. But that's come back now to be, much lower levels, maybe only 10 to 20 basis points ahead of the majors. So what kind of margin benefits could we see if this is sustained into FY17? And secondly, how will the Virgin Money deposit product launch affect your pricing position?
First of all, I'm not going to flag to my competitors what we're going to launch for Virgin Money, so you'll just have to wait and see. And again, it'll be an innovative product. It won't necessarily be a term deposit product. It'll be a transaction account. Secondly, it is very difficult to forecast what the NIM impact would be on term deposit pricing. Markets move virtually, week by week, and we've seen a significant fall in term deposit pricing over parts of the curve, particularly in the 12-month curve in the last few weeks. We've adjusted our rates. We'll continue to adjust and optimise the rates that match for our asset growth, but more importantly, as I said, to fight for every basis point of net interest margin on that side of the balance sheet.
Thank you.
And we've got another question, Mary, to your left.
Thanks. Brett Lemaitre from Velocity Trade. A couple of questions. Where are you on your net stable funding ratio at the moment? I think the last time you said something, you're around 100%.
Yes, so obviously it's yet to finalise itself definitively. We did get some additional guidance out of APRA on some interpretations over the last 2 or 3 weeks. So we're still a little above probably where we sat last time based upon those new interpretations. There's a broader discussion that needs to play out around the acceptable acceptable buffers that then apply to over and above that 100% minimum, and we're waiting to see. We're circa the 105 area.
You can't make a guess as to what the buffer might need to be?
Well, what I would say is that in liquidity, we've been running around the 120-125% level, so 20-25% buffer. That liquidity ratio, quite deliberately, moves, with some volatility if you make even small changes in your overall liquidity and balance sheet management position, whereas the net stable funding ratio is intended to be a much slower directional move, and we would expect much lower buffer requirements than exist on the liquidity framework.
It would be fair. You mentioned that your loan growth was fully funded by deposit growth this year. You would expect that to be the case for 2017 financial year as well?
Look, the opportunity for us in loan growth is quite large. We've got a diverse set of businesses. For example, we've got many thousands of customers in BOQ Finance that we've rarely tapped into, other than just with one product for the leasing. BOQ Specialist has been a wonderful acquisition for us and a wonderful business. Not only does it drive asset growth in the home loan space and also significant growth in the commercial space for doctors and dentists, it is also a great vein of deposits as well, which we'll continue to work with to offer deposit products through that business as well. And across the BOQ growth, as Anthony mentioned today, we saw significant growth, 320-odd million, in your current accounts, which is in banking is gold, and we'll continue that as well.
We might just take one more call from the room before we go to the phones.
Oh, can I ask one more question?
Can we just take one? We've got a couple of calls, and we can come back to you if that's okay.
David Ellis from Morningstar Equity Research. I've got a couple of questions on the dividend. The cash EPS fell 2%, yet the dividend increased 3%. So what's the rationale behind that? And does BOQ have a published dividend payout target range? And thirdly, what's the long-term historical average payout ratio for the bank?
So I'll make a couple of comments about the dividend. First thing I'll draw your attention to our strong capital position at 9%, and we Tier 1, we actually grew that over the year. Also in the past, we've given some guidance around dividend growth should mirror EPS growth. And over the last few years, we've grown our dividends, but also our EPS. We're quite comfortable with what was declared for the second half and for the full year in relation to those two aspects. And I'll hand over to Anthony if you want to make an additional comment.
I think the point is the board takes a medium-term time horizon in setting the dividend profile, and so we'll be looking to a medium-term future. At a specific level, the actual statutory payout ratio actually reduced this period. So in a true capital generation sense, that we didn't have a contraction in capital generated. So it was in line with that statutory piece. Obviously, there's a combination of factors that we look at in that determination, but we're very comfortable with that profile. It has remained flat at that level for the last 3 half-year periods, which does reflect the earnings growth profile that we have had in the business over that period.
Okay, we might go to the phones now.
Your first question comes from the line of Craig Williams from Citi. Please ask your question.
Yes, thank you. I have a couple of questions as well, if I may, please. With respect to cost performance, that was perhaps a little disappointing element of this result. In second half 16, I think it was up 5%, excluding restructuring on PCP, and 8%, including restructuring on the PCP period. And you've indicated that your payback sort of come through in advance of plan in terms of the restructuring initiatives that you undertook. And whilst I'm certainly encouraged by the message on costs for FY17, can you flesh out why you have confidence on execution and why, with what you've done so far, that you do have confidence in terms of what you can do on costs for the coming year? And how far have you actually already reaped the cost savings from the restructuring you've invested in FY16, given the 100% payback expectation that you flagged in February? And a second question, I'll leave perhaps until after you respond.
Craig, it's John here. I'll make some general comments about costs and why we're confident. And if you remember back a few halves ago, I said that some of the technology we employed at the bank was cutting edge in fax machines and couriers. And I'm really pleased to say that we've reduced the number of fax machines and couriers. I know, but in reality, what we are absolutely doing is moving at pace with cheque digitisation, with e-statements, with moving towards one mortgage hub. We actually have probably 3 different ways of processing mortgages, so we're moving to one mortgage hub. Let me give you another example of why we are confident about getting those cost savings. Previously, in banks, when you wanted to do something, you would have to actually hardwire or replumb parts of your banking system. We actually employed a number of people to rekey data into disparate systems to actually process a mortgage. We've just employed 3 robots. They cost $6,000 each. They've taken the rekeying time from 45 minutes to 6 minutes with 100% accuracy. So it's these incremental measures that we're actually taking throughout the business, and with a significant change, rather than from doing large-scale projects which require large-scale replumbing of systems and architecture, to actually using cutting-edge technology such as robots. We have a number of other initiatives underway that will continue to try and take the cost out of the place and reduce our fax machines and stop toll being our number one customer for toll, which we're doing.
Okay, thank you. And I think you called out that banks have recently sort of pulled back a little bit on their 12-month term deposit pricing in the last couple of weeks, which seems to indicate that the benefit to deposit customers in balancing stakeholder needs was pretty transitory. as the banks have been calling out with the latest round of mortgage repricing. So I'd argue that the industry is perhaps at risk of further government intervention through these sorts of practices. So how much capacity do you think banks have now to continue to rely upon mortgage repricing as a tool for driving revenue, as there appears to be a breakdown in trust with the public occurring?
So, Craig, as you would well know, and everyone in the room, that it's impossible for me to make any comment about what we would do or will do with mortgage repricing. What I will say though is that the industry itself, if you start at the very basics, this country has been importing capital from the day it started in the 1800s. Our self-saving ratios for all the banks are sitting between 65 and 68%. And if you look at where we are now with the official cash rate and the low interest rate environment, it is a conundrum for the industry in how it will fund itself going forward. So you actually need to absolutely maintain strength in banks because we rely so heavily on offshore capital. And I'm sure that the industry, over time, will work through the various dynamics of both the asset and the liability side of pricing. And from BOQ's perspective, we've been 145 years around and we'll remain competitive and we'll continue to offer competitive products to our customers, but also watching where our margins are. And it is difficult operating a bank in a low interest rate environment.
Our next caller.
Your next question comes from the line of David Spotswood from Shaw and Partners. Please ask your question.
Yeah, no, well done on the cost guidance and the de-risking of the book. Just on, obviously, the margins, one of the key drivers to the revenue and the profitability of the company, and you've given some slides there, you're saying front book, back book, -5 basis points in the second half, low interest rates 4 basis points, maybe hedging 0 and maybe a bit off TDs, so you're at sort of 10 basis points funding pressure, but you kept 13 basis points of the last 25 rate cut and you've stopped the heavy discounting on the Clear Path product. So the second half, NIM was 190. Either any sort of comments on the exit NIM, or as we sit here today, is it reasonable to assume that margins, and you're focusing on margins, 2 to 3 basis points off that 190 is a reasonable estimate going into 2016 and 17? That's the sort of first question. And the second question, if you look at the APRA data, the loan growth in the second half of 0.6, but the fourth quarter was negative, it fell for every month. So would 2 to 3% loan growth in 2016 and 17 be a good outcome? Thank you.
I'll deal with the loan growth, and Anthony can talk to the NIM questions. Again, I'm very heartened by what we're seeing. We're a month into the new year. We're into our spring campaign. We've got great momentum in BOQ Specialist. That business, we put $1.5 billion worth of mortgages on the book last year. Its asset growth in the commercial book is 13%. In the business banking world, particularly in our specialist niche, in the niche business that we've got, there again growing above market. On the mortgage front, we're back in consideration with the brokers across the broker network, and Virgin Money, I believe, will make a material contribution to the group over time. In a very, very short period of time, we've had $100 million worth of applications for the Virgin Money home loan. And when I look at like for like, in terms of where BOQ was in terms of its first offering to the brokers and to where Virgin is, there's a significant outperformance by Virgin in these early days yet. It's only early days, I'd caution on that, but I believe that with the varied distribution channels and brands that we have, we are well positioned for growth, which actually gives us great optionality across the group as well.
Just to follow on that one very quickly, David, I did call out earlier that it really wasn't until August and the RBA rate move and the market's reaction, the industry's reaction to that, where we believed we were back at a position where we could compete in the mortgage space. We just simply weren't able to, we believe, deliver appropriate risk return with the pricing point that was in the market, and that was evident in the broker space. So again, I think our confidence that we're at the right price point, it obviously takes time to build a pipeline and for that to come through into settlements. So we do expect a bit of a lag there. As far as the margin is concerned, we're not going to give, as we've said, any clear guidance because there are so many moving parts. I mean, but just decomposing some of the items that we called out on the margin chart, the repricing steps that have been taken to date in the portfolio, which are public, probably generate in the order of 7 basis points into the next half. Now, there's been this front to back book pricing dynamic, which with a few other moving parts were in aggregate 5 basis points last half. I think you would expect that there will be some element of degradation out of that line, whether it's to what extent. Again, we would expect some degradation. The hedging costs, we would hope that if market conditions prevail as they are, that will be flat. Capital and low cost deposits is effectively locked in as a 4 basis point degradation in the next half. So really it comes down to where that funding cost and mix line lands, and that's the one that's inherently open to the dynamics of the yield curve and the dynamics of the industry's response to how all of that plays out. So that's the best sort of steer we can give you on all the moving parts.
We have another question.
Your next question comes from live of Ashley Dozil from Goldman Sachs. Please ask your question.
Thanks and good morning, guys. Just picking up from the last question. I suppose we've seen just in the last couple of months term wholesale funding spreads actually tighten in by a little. Can I just ask if you're seeing the same sort of trend within the domestic short-term wholesale segments that you play in? And secondly, just around the capital and low-cost deposits and the replicating portfolio there, and you flagged that 4 bp headwind is probably locked in for the first half of 17. If we assume essentially a flat yield curve from here, would you assume a similar amount of headwind in the second half of 17 as well?
So if I take the second part of that question first, the answer to that is yes. Directionally, that's that type of profile going forward. As far as the term wholesale funding spreads, there has been a retracement from the widest spread over recent periods, maybe in the order of 20 basis points, sort of across elements of the curve. And it does appear that those markets are arguably operating more effectively than they had been previously. We're also seeing some improvement in the RMBS market, and it's getting close to, if not already there, at levels where you could probably complete a capital relief transaction. So I think we're reasonably comfortable with the forward outlook for our issuance over the period. As far as the wholesale spreads are concerned and middle market, they're still pretty stubbornly wide, I would say. In fact, if you look at the curve, there is a really interesting kink at the 6-month part of the curve. It's about 25 basis points wider than all other elements. And I think what you're finding there is everybody shifting that wholesale space out to the 6 to 12-month bucket, where it used to operate in a 90 to 180 days. And that kink in the curve, I think, does demonstrate there is some market-based pressures that are at play in that space at the moment. So we're watching it closely, but at this stage don't seem to see any relief on that side.
Okay, thanks. And just if I could follow up a question, I suppose, around the branch network and expenses. You've sort of closed down another 13 in the half, about 23 for the year. Are you sort of largely through that footprint rationalisation now? And can I sort of also ask just for a bit of an update on the OMB channel, how many of those guys you have on the new scorecard and how that's been going through the half?
Yeah, look, we're very excited about the new scorecard. We've got close to 48% now on the new scorecard, and that is driving significant uplift in outcomes for us, particularly on the risk management side. We've had a great uplift in all of our branch audits across the branch. All of our owner managers are incentive on a balanced scorecard in terms of deposit gathering, customer service, asset growth, and actually serving the whole of the customer needs. And we would expect that to again increase in the number over the next couple of years to get to around the 80% mark for the balanced scorecard. In terms of branch numbers and branch network, I've talked about this in the past, is you just can't just necessarily focus on branch numbers. You've got to really focus on distribution channels and how and when customers want to deal with a financial institution. And for us, we've been configuring that network. We've seen a number of owner-managers retire. We've seen a number of owner-managers buy into additional branches. And we've also closed a number of those branches because they're actually not in great locations or the demographic is not right. Also, what we don't talk about a lot is we have a small online digital channel. It's grown about $100 million in mortgages over the last 12 months. And then if you look at what we're doing with Virgin and the brokerage coverage you have, we're very comfortable with the distribution footprint. Distribution footprints will change as digitisation rapidly expands across the finance sector over time.
And we've got one last call, one last question on the phone.
Your last question comes from the line of Mr. German from Macquarie Bank. Please ask your question.
Great, thank you. I also had just a couple of questions which I wanted to ask. The first one is a pretty simple one. Throughout the presentation we referred to underlying expenses. Would it be fair to assume that underlying expenses in FY17 should be in line with reported expenses, or is there anything else that we need to keep in mind on the expenses side?
So we've said underlying expenses are $505 million, and we've given guidance at 1% growth on that number.
No, I appreciate that, but what I'm saying is, in earlier periods, we've had some additional expenses on top of underlying. There is nothing that should be coming through this period, is there?
We're very clear on the guidance we've given on costs, 1%.
Okay. Okay. So the second question I had was just following up on earlier discussion around deposits, and it's quite difficult to work out exactly what's driving sort of deposit margin movements because different banks treat hedging costs differently and things like that. Following from maybe what John has asked earlier, are you able to give us a sense of what has resulted in that margin pressure on your deposit book? We haven't really seen sort of similar commentary from your peers. I've noticed that your deposit mix has shifted a little bit towards more term deposits away from saving deposits. Perhaps that was one of the drivers. But just maybe if you can provide a little bit of a colour as to what's driving more sort of deposit pressure for you guys relative to what we've seen with your competitors.
I can't possibly make any comment on what our competitors have been doing, but certainly when you saw those elevated 12-month rates, which were led by some of the big four, that certainly cost the industry. Now, those deposit rates have come down. But I also just want to point out, we're running the bank here for the long term and not for the short term. And if you think about liquidity and liquidity risk and where banks are, having a deposit base and term deposit base that we actually have is a very, very good thing over the long term. I'd also point you back to the earlier comments that we actually made. We have seen $320 million worth of growth. I know it doesn't sound like a lot, but it's meaningful to us, BOQ, as a smaller niche player, in our current accounts. So we're actually putting more current accounts on, opening up more accounts for people to deposit their pay in, week out. And that's a slow burn, and we will continue to do that. But we'll also respond to what we see as the competitive pressures across the TD market. And a lot of what we're seeing at the moment is because we're operating in an ultra-low interest rate environment, and we're all adapting to that environment. But I remain confident that our deposit growth, the opportunities for further deposit growth against the various businesses and business lines we have, will see us in good stead over the medium term.
Yeah, no, I completely appreciate the point around deposits and how important they are. Traditionally, your deposit pricing has been generally above market. As interest rates are coming down, do you think there is need for you to maintain that premium to the market in order to be able to attract deposits?
As I said in the past, during the presentation, we're doing a lot of work on data analytics to absolutely ensure that we have the right the right pricing for the mix that we have for our asset growth. We don't just, we actually put it all into our thinking around what is the right asset mix that we actually want, the right asset growth we want, how do we fund it in terms of also where our dividend will be. So rest assured that we are doing everything to ensure that we actually have the right sort of deposit pricing for the asset growth that we actually want, managing both sides of the balance sheet in what is a very low interest rate environment.
Okay, thank you. And the last point, I just wanted to, with the retail system that you've been investing in, when do you expect that project to be completed, and do you expect that to result in better volume growth from the broker channel without necessarily needing to lead by price?
Yeah, look, we've had that system up and operating for a number of our loan products, and our time to yes has just materially improved. We've gone from, in the early days, we didn't know when a home loan hit the branch, to now where our branch people can actually give an unconditional yes if we can tick all the boxes on the same day. We're now taking that right through the rest of the products we offer. We will never get to 100% of all products because some of the products or some of the loans can be quite complex. We'll finish that work towards the end of this year and early next year. And yes, we do expect better outcomes, not just for our brokers, but for our branches and our owner managers as well.
I think, as an organisation, we've actually done a lot of heavy lifting over the last 12 months on that retail lending origination program, on the commercial lending origination environment that John called out earlier, which effectively does the same thing in digitising our small business and commercial pipeline. And we've also launched the Virgin Money mortgage product. A lot of the benefits of those programs are not going to be evident in the economics of our results in this period. They are foundational for longer term, medium and longer term growth profile.
I might just give Brett the opportunity in the room to ask that question that he wanted to ask. Before we wrap up. This is the last question.
Thanks. I was interested in the difference in the loan margins that you had between commercial lending and residential lending. You just put an average in there. And since you were growing commercial lending and you weren't growing residential lending, I was wondering what the benefit was that we could look forward to.
We're not going to disclose exactly what that benefit is, but if I can just talk about the lines of business that we actually have. If you look at BOQ Finance, it is a higher margin business, and there are elements within that that are very good for us. And just draw your attention to the sorts of lines of business that we do there. For example, we stand behind one of the largest global, PC makers, and again, that's a great business to be in from a margin perspective. We also stand behind a number of motorcycles, and we've had a 10-year relationship with Honda Motorcycles. So if anyone wants a motorbike, I'm sure we could help you. But again, that's a high margin business. If I look to some of the comments that Anthony made earlier, particularly in the commercial lending space, we've actually seen a moderation in the competition as rates have moved. And again, for us, it's looking at also the ancillary services that we actually have there as well. And if you look at BOQ Specialists, serving the needs of the doctors and dentists in that professional segment, it's not only just the home loan, it's also the practice financing, it's also the specialised equipment financing that goes with that. And again, that's why we're very confident about the outlook, the longer term for us, for our goal on EPS outperformance, is that we are very focused on these strategic niche markets. We don't want to be all things to all people. We don't want to be a mini-me of a Big Four bank. And that's the pleasing aspect, is the progress that we've actually made against our strategic objectives.
Well, that brings an end to the briefing. Thank you so much for joining us, and there'll be some light refreshments as well on your way out. Thank you.